What are three things to do with excess cash from selling a business? In this video, we're going to take a look at three different techniques that we commonly use with our clients after the sale of a business, and really kind of marrying up your assets you have now, how they've transformed with the sale of the business. And really now we're taking, that massive value that is the business, and it's now cash. What do you do with that cash? This mythical value of the business is now very realized. It's very tangible. It's in a bank. You can go and hold it. So what do you do with that extra cash? So the first thing that we do when we take a look at the sale of a business is we really look at having a financial plan. You need to have that financial plan in place in advance. The reason why you do that is, here's a simple one-page financial plan that we put together for our clients. It kind of tells you, what are our key goals, whether that's the sale of the business at that time, mitigating taxes, kind of a snapshot of your net worth here, some KPIs, savings or spending, when we're going to hit financial freedom and what that looks like. Also, you have these action items. And the reason why we have these action items here is because when you sell that business and it goes from a mythical value to real hard dollars, we want to have concrete action steps as to what we're going to take. The reason why we want to have those action steps as to what we take is because there are so many different investment opportunities that are out there. First one, again, is we're going to start with a written financial plan so we know where we're headed, and then we need to know how we're going to go do that. How we're going to do that is through a combination of different monies and different purposes. The first thing is, let's use round numbers. Say I sell for $1 million. My taxes that are due from that, I'm going to use round numbers. I owe $300,000. On that $1 million, I instantly strip out $300,000. I'm left with $700 left over. Now I build from the inside out. So the first thing is I want to have cash on hand. Cash, depending on how old you are and the lifestyle you live, we want to have anywhere from 6 months to 2 years of cash on hand. I'm going to fill up this cash bucket to make sure we have everything here. And the next thing I'm going to go look to do is with stocks and bonds. With stocks and bonds, specifically in the year of a high tax bracket, I'm going to look if I can mitigate taxes a little bit more. We're going to talk about that more here in a second. And finally, whether we go into private real estate or small businesses, this is going to be driven by where we're headed within that financial plan, where are we headed in the future, then which assets do we need today? And the reason why we're doing that is if you take a look at net worth compositions, take a look here. This is a study done by the Federal Reserve. Take a look here at, a net worth. What you'll see is popping out here, purple getting smaller. That's your primary residence. Getting larger is this bright green. And this bright green is business equity, so small businesses, and other real estate, so income producing real estate. We're going to come back here and say, look, we know that when your net worth is over $10 million, roughly about half of your net worth is in businesses and income producing real estate. That's why we're able to kind of say, look, this is a picture in the past on how to be successful for entrepreneurs when we have that extra cash. And then we're using these different monies and different purposes for knowing what types of investments do we want to go into. Do we want to go into real estate so it has real strong cash flow? We have the opportunity to potentially have even higher cash flow than you do with stocks and bonds. Or are we going into another business venture, which yes, it's riskier, but we're looking for a larger payout. Third and final thing is after I have a written financial plan and I'm considering the different asset classes that I can potentially invest in, I'm going to look to mitigate taxes with my extra cash. Remember, we talked about it. I started up here with $1 million. Going forward, I'm actually going to carve off about $300 for taxes. This money, we're going to lock it down. You put this into a money market fund. Then with the extra $700,000, I'm going to look to do a couple things. The first is I'm going to think about my taxes. Change our color here. We're going to make it red because nobody likes taxes. Taxes kind of build on one another. Your first level here is on ordinary income. So this is from your profits and also your income. Think about the draw that you're taking from the business. This is your first layer that gets taxed. Sitting above that are your capital gains. So decisions that you make down here, if we can make this smaller, we then ideally, potentially in this scenario of around $1 million in capital gains, more tax savings we have down here, we can lower our capital gains as well. So some ideas that we can do to lower those capital gains, again, by marrying our investments with our taxes is, let's say in a given year, this business is going to cash flow $300,000, okay? This is through a combination, again, of profits and draw, the salary that you're taking from it. We could potentially look to do, again, we had the $300,000, we're locking that up. That is for our taxes. We're going to put that in a lockbox. That's going to be in a money market account. Extra $700,000, we could look to make a $100,000 investment, and that can be in IDCs. Now, you got to be very careful here, but there's certain providers where we're able to make an investment in an oil and gas fund, and your subsequent investment is we are able to lower our earned income by around $75,000. So now that 300,000 is now 225. Okay. And it frees up more money here in the capital gains to get taxed at a lower capital gains rate. That's the first thing that we can do, is that we put some money into an IDC investment. The second thing we can do is, if it's early enough in the year, again, we made $1 million in our capital gains. Okay. We can take the $300,000 remains in the money market. It's got to be super safe, super liquid. We're not going to take any risk with it. Portion of the 700K, let's go ahead and do $100,000. 100K into the stock market. In 3 out of 4 years, the stock market is up. Average up years is around 20%. Average down years is around 8%. But with the volatility in the stock market, is what we can do is going to come in here and we're going to sell the business right in the beginning of the year, right here in February, okay? This gain here, it comes back down, it goes back up, okay? If it ends up and we made money, then the money that we made, we help pay for the taxes that are due, the 300K. Conversely, if we lose money down here, the loss in the stock market partially offsets the gain in the business. What we want to do is we want to be invested in, think of like the S&P 500 or an index, which historically over time has come back. When we're doing that, then we know that, oh, look, I locked in that loss down here, but ideally over time, and we've seen this before with like the S&P 500, where losses are temporary and the gains come back over time. We don't want to do it with an individual stock because that's too risky. Stocks aren't going to always come back on an individual name, but when we're in a basket of stocks, we have more comfort with that. As a reminder, the 3 things that I would do with excess cash from a sale of a business is, 1, start with the written financial plan so that we know that where we're at today, we're headed in the right direction. 2, looking at investments outside of just stocks and bonds, because we can potentially get greater cash flow from real estate, or we can look at potentially higher returns with small businesses. And then the third thing is marry your investments to your tax strategy. This is how we would look to take your investments today and the excess cash from the sale of the business to not just lower your taxes, but achieve those long-term goals that you have.